Hello, everyone. Welcome to today's presentation brought to you by TIAA with the National Urban League on closing the financial literacy gap to harness the economic power of African Americans. A few housekeeping notes before we begin. First, while you are on mute, we do still want to hear from you. So please ask your questions in the Q&A box, and we will get to your questions either during the panel discussion or the Q&A portion of today. Questions can be submitted at any time during today's session, and we welcome your questions. We also recommend that you use both video and audio for today's event, as the presentation portion will have interesting PowerPoint slides that will supplement your experience. Also, please note that this session is being recorded and will be posted publicly. So please share this with your networks, or you can return to it later just for yourself if you like. And finally, if you're having technical difficulties, please message us via chat or email Silky Misra at misra@nul.org. My name is Ayana Fortson, and I am the Director of Housing and Community Development for the National Urban League. And I am excited to join you as today's moderator. We are very grateful to TIAA in providing us with the opportunity to jointly hold such an important session. Today, we will focus on the financial literacy knowledge of African Americans and how increasing financial literacy comprehension can lead to greater economic opportunity. So I want to kick off today's session with a quote that is as relevant today as it was years ago when it was written by the late great writer, James Baldwin. He said, "Not everything that is faced can be changed, but nothing can be changed until it is faced." I'm going to say that one more time because it is so relevant to today's discussion. James Baldwin wrote, "Not everything that is faced can be changed, but nothing can be changed until it is faced." Today, we will face some difficult conversations about what is happening in our communities. While you are already known experts in your communities, the information provided today by TIAA will provide you with the laser-focused data that is needed to know what issues most need to be addressed. After the presentations by TIAA, we will launch into an exciting panel discussion where we will explore not only where we are now, but how we got here and where we can go next. One thing that is clear is that numerous factors have led to both the racial wealth gap and the financial literacy gap, and we must also use numerous tools from our toolbox in addressing these gaps. So where do we go from here? How can we address historical inequities and inequalities with modern day approaches? At the Urban League, we are proud to focus on a multi-pronged approach to economic empowerment that includes advocacy, academic education, financial literacy education, housing counseling, workforce training, entrepreneurship, and health. For today, we will focus on the areas of financial literacy so we can create even more focus within our own group education and counseling work. So let's get started. First, we will hear opening remarks from TIAA's own Colbert Narcisse. Colbert Narcisse is the Executive Vice President and Head of TIAA Wealth Management. He leads the development and execution of the firm's comprehensive wealth management strategy. Prior to joining TIAA, Mr. Narcisse served as the Managing Director and Head of International Wealth Management at Morgan Stanley. And he also previously served as the Head of Product Strategy and Development and the Head of Traditional and Alternative Investment Products for Morgan Stanley's Global Wealth Management. Mr. Narcise's experience also includes more than 17 years of experience in senior management roles in both investment banking and wealth management at Merrill Lynch. He started his career as a bank examiner with the Federal Reserve Bank of New York. Mr. Narcise earned his undergraduate degree in finance from NYU and his MBA from Harvard Business School. He is a member of the Executive Leadership Council and a former David Rockefeller Fellow. Mr. Narcise was named one of the top 75 Blacks on Wall Street by Black Enterprise. He was also named one of 2019's Haitian American Changemakers and Ones to Watch in the US by the Haitian Roundtable. Mr. Narcise has appeared on CNBC's Fast Money Halftime Report and Fox Business Network's Wall Street Week. Welcome, Mr. Narcise. You have the floor.
Thank you so much, Ayana, and thank you for that kind introduction. It's been a real pleasure getting to know many of you over the course of the last several days in anticipation of what I believe will be a very robust discussion on closing the financial literacy gap to harness the economic power of Black Americans. Maybe I'll make some introductory remarks around and level set the conversation that we're going to have today. And maybe I'll start with a definition of financial literacy. Financial literacy is defined as having the knowledge and understanding that enables sound financial decision-making and effective management of one's personal finances. It is having the skills to apply that knowledge and understanding in order to make informed decisions across a broad range of issues, including saving, investing, and retirement, as well as risk mitigation. So that is a working definition. Obviously, there are many other aspects of financial literacy. It's the foundation by which many of us have to organize ourselves, and quite frankly, it's a life skill. But I want to provide some context by giving some data around understanding of financial literacy, as well as some of the economic disparities across a broad range of groups in the United States. The TIAA Institute put together a personal finance index. And what they did was they tried to isolate the number of questions that were answered correctly amongst different groups. The average number of questions answered correctly by African Americans was 38% versus 55% for whites, a difference of 17 percentage points, pretty significant. But let's put some context around those numbers. On average, Black families who are feeling financially stable were about 65%. The comparable figure among whites was close to 80%. Contributing to that significant difference in that, those results were the fact that the median household income among African Americans was $35,400 in 2016 versus a median household income of whites of nearly $62,000. McKinsey & Company released a study earlier this year that compared white Americans and Black Americans and found that Black Americans are more likely to hold jobs that are threatened by reductions in hours or pay, temporary furloughs, or permanent layoffs. COVID-19 has further exacerbated some of these differences. It has made it even more difficult to get access and maintain access to good healthcare, stable housing, and that has had a very negative impact on the aspirations of many Blacks who wish to enter the economic mainstream of this country. COVID-19 has taken the lives of Black Americans at nearly twice the rate of white Americans. With the exception of Asian Americans, have seen worse outcomes than whites during the pandemic, but Black Americans, unfortunately, have fared the worst of all. About 1 in every 1,000 Black Americans died, while the rate for white Americans is 1 in every 2,100, excuse me. Why is this happening? Black families are 5 times more likely than white families to live in areas of concentrated poverty, so the risk of contracting the disease is higher. They have lower access to testing and a heightened risk of pre-existing complications. So if we consider the combined effects of the financial literacy gap, less relative wealth, the COVID-19 crisis, and other underlying structural factors, Black families will face disproportionately greater economic and financial challenges as this crisis continues. It is critically important for us to address the financial literacy gap in the African American community, especially if we want to change the economic trajectory of this country. When this country does well, all do well. And we know that those who are more financially literate are more likely to plan and save for retirement, to have non-retirement savings, and to more appropriately manage their debt. There will be no easy or quick solutions to these challenges. It will require input from legislative changes, sound public policy, the business community, and organizations like the National Urban League that have expertise on race, community building to address these systemic issues. As we will hear shortly from my colleague, Paula Jakubowski, the TIAA Institute's Personal Finance Index has surfaced valuable insights that can inform how to improve financial literacy in the African American community. At TIAA, we are honored to share these insights with you, National Urban League leaders, because you lead community initiatives that are improving the financial literacy gap in our communities across the country. The National Urban League supports this worthy mission through a variety of programs and initiatives designed to better educating Black youth and adults about managing their personal finances. It is great that TIAA has the opportunity to partner and collaborate with organizations like the National Urban League to share research, identify ways to further develop the actions and solutions necessary to help us solve these long-term structural socioeconomic issues. Today, we will learn from my other panelists on the recent research study examining the current state of financial literacy and wellness among African Americans. And hopefully we will end our discussion with a few takeaways on the roles we can all play individually and as institutions in helping to close this gap and hopefully improve these statistics moving forward. With that, thank you for your time. Looking forward to a robust discussion, and I'll turn it back to Ayanna.
Thank you so much, Mr. Narcisse. Next, we will have a presentation by Paul Jakubowski. Mr. Jakubowski is a senior economist with the TIAA Institute. His research agenda focuses on financial literacy and wellness, retirement savings and investing, the retirement decision, and asset management during retirement. Mr. Jakubowski also conducts research on workforce issues in the higher education and nonprofit sectors. He leads the Institute's survey research program and is the director of the Institute's Fellows Program. Prior to joining the TIAA Institute, Mr. Jakubowski held positions as Director of Policy Research for the American Council of Life Insurers, Senior Research Associate with the Employee Benefit Research Institute, and Senior Economist with the U.S. Government Accountability Office. He previously served as Director of Research for the American Savings Education Council and was an adjunct instructor at Nazareth College. Mr. Jakubowski is a member of the American Economic Association and the National Academy of Social Insurance. He also serves on the board of the Journal of Retirement, the Editorial Advisory Board of Benefits Quarterly, and the Society of Actuaries Committee on Post-Retirement Needs and Risks. Mr. Jakubowski earned his PhD and MA in economics from the University of Rochester and his BS in economics from Virginia Tech. Welcome, Mr. Jakubowski. You have the floor.
Thank you, Ayanna. And somewhere my mother's very happy that you read my bio exactly like she wrote it. Good afternoon, everyone, and thank you to Cy and NUL for hosting this webinar. It's really a genuine pleasure to join you today. Financial well-being, financial wellness, we all want it. As individuals, we want it for ourselves, we want it for our families, we want it for our loved ones. As citizens, as advocates, we want it for our communities. Achieving financial wellness, it's not straightforward and it's not simple, however. It's not just a matter of having a good job and having enough money. Certainly resources matter, absolutely. So too does opportunity and access in a financial system. And so too does the ability to make sound, appropriate financial decisions. And the latter is why we care about financial literacy. As Colbert just said, financial literacy is knowledge and understanding that enable sound financial decision making, and it enables effective management of personal finances. So for the next 10 minutes, I'd like to discuss the state of financial literacy in the US, and in particular, financial literacy among African Americans. Again, as Colbert mentioned, I'm going to use data from the Personal Finance Index. We call it PFIN Index for short. And this is an ongoing joint project of the TIAA Institute with the Global Financial Literacy Excellence Center at George Washington University. And on the slide here, you see various points about the index. In essence, it's an annual barometer of financial literacy among the US adult population. And we built it around these 8 functional areas that you see listed. And every year we field the index survey in January. And in addition to surveying the US adult population, we oversample a particular demographic group. In 2019, that demographic group was African Americans. When we oversampled African Americans, we found that on average, African American adults answered about 40% of the index questions correctly. And the bars here on the right, you see the distribution of those correct answers. So approximately 28% of African American adults answered over 50% of the index questions correctly. To put this into perspective, comparing that with white adults, we see a differential of about 17 percentage points. Again, Colbert mentioned that point earlier. So African Americans lag whites. At the same time, it's not exactly like that 55% figure among whites is good. Let's face it, it's a little over half of the questions correctly. It's not that good. So in the big picture, financial literacy is a challenge among the US adult population in general. And then within that, specific subgroups, it can be a bigger challenge than elsewhere. Looking within the African American community, here we see how financial literacy varies along various dimensions. So by gender, by age, by household income, for example. And these are the same patterns really that you observe in the population at large. So men tend to have greater financial literacy than women. Financial literacy levels tend to increase with age. Older individuals, experience, et cetera, tend to have higher financial literacy levels. It's also higher by household income, dramatically so. Here you see in the lowest income group, under 25,000, the average number of questions answered correctly was 23%. It's more than double when we look at African Americans with household incomes of $100,000 or more. And financial literacy, not surprisingly, varies with education level, both formal education as well as financial education specifically. So again, we see here really dramatic rise when we look at individuals with less than a high school degree, all the way up to those with a college degree. Again, more than a doubling in a financial literacy level of African Americans by these education. And then we see, as we would expect, those with some form of financial education. And this was either at school, in the workplace, could have been in high school or college, but we see that those who have received financial education somewhere at some point do demonstrate higher financial literacy. As I mentioned, as I showed a few minutes ago, the index, what makes it unique is we're able to look at financial literacy along different functional areas that individuals naturally operate in a normal course of life. And here, what we've done is rank ordered where financial literacy tends to be relatively high versus relatively low. And we see that among African Americans, borrowing is the area where financial literacy tends to be highest. Almost half of those questions are answered correctly on average. And this is a finding that is not unique to African American adults. We see this in adults at large, and we've actually observed this same ranking through all 4 years that we've been conducting the index thus far. At the other end of the spectrum, insuring is the area where African American financial literacy tends to be lowest. So understanding insurance and the basics of insurance, how it works, and really close behind, you see comprehending risk. Somewhat related, but here we're talking about beyond investment risk, just a comfort level and understanding of the inherent uncertainty that's involved in making financial decisions, that outcomes aren't necessarily known with certainty. And individuals have to grasp risk and be comfortable operating in this environment. Well, now, before I move on, sorry, mention one more thing. If I was to compare these specific functional areas with white Americans, you'd see an analogous gap to what we showed before. Again, African Americans lag along these functional areas anywhere from about 10 percentage points to 20 percentage point differential in the percentage correct. The one exception being the area of comprehending risk. There the scores are in essence identical. So that's really kind of a problem area that permeates across the spectrum of US adults. And the one other thing I'd mention here is I think the value here is maybe highlighting areas to think about when we're talking about financial education programs and financial literacy that aren't necessarily top of mind. Things like insurance, things like risk and understanding risk, not always covered in financial literacy programs, but clearly points of need and areas to focus on. Finally, let me talk about the link between financial literacy and financial wellness. Because again, we don't care about financial literacy for the sake of financial literacy. We care about financial literacy because it moves us to, helps us maintain, gain a state of financial well-being. And what we include in a survey every year is several questions that are indicators, if you will, of financial wellness. And this enables us to look at the link between financial literacy and financial well-being. So here, one indicator is financial fragility or financial resiliency. We look at it from the other side. And a couple things to note here. As financial literacy levels increase among African Americans, their degree of financial fragility decreases. So here we're talking about ability to come up with $2,000 for an unexpected emergency, come up with it in the short term. Among all African Americans, about 60% say, yes, I'm certain or fairly certain that I can do that. That percentage rises consistently with financial literacy levels among African Americans. Among those answering about half or to 3/4 of the questions correctly, that percentage rises to 77%. Among those answering over 75% correctly, in essence, 90% of African Americans answer those questions correctly. And the other thing that I think is of is we observe between adults, compare them to all white adults, we see that we have 60% versus 76%. But when you compare them holding financial literacy levels constant, so comparing them at those highest levels of financial literacy, we see that differential go away. 77% versus 77, 89 versus 93, essentially identical figures. So using the term very loosely, financial literacy is serving as a degree of equalizer along this dimension of financial well-being. And we see this phenomena in other places with other indicators. So here we're looking at the percentage of workers who save for retirement on a regular basis. Again, the same phenomenons. As financial literacy levels go up, the likelihood of individuals saving for retirement goes up. And we also see that gap in a fraction of individuals saving between African Americans and whites go away at the highest levels of financial literacy. Again, those percentages, even the point estimates are identical, 90%, 90% at the highest levels of financial literacy. Again, here we're looking at percentage who have non-retirement financial savings and the same exact phenomenons. Now, it doesn't hold everywhere that we had an indicator. So here we're looking at degree of debt constraint among individuals and a gap that exists among all African-American adults and all white adults. We see that same degree of gap among those with the highest levels of financial literacy. So it's not that anyone's pretending financial literacy is the magic bullet, the cure-all. I think the key takeaway is it can make a big difference, a fundamental difference in the level of financial well-being of individuals, even those with limited resources, and helping them manage those resources in the best way possible. So let me turn it back to you, Ayana, and the rest of the panel. Thank you.
Thank you. Sorry about that, technical difficulties. Thank you so much, Mr. Yakubowski. Next, we will move into the panel discussion. So I'm going to start off by introducing two Urban League leaders who you have not yet met, who are powerful in the movement and will share their unique perspectives. After introductions, we will have the panel discussion followed by Q&A with questions from you. So please do remember to put your questions in the Q&A section or in the chat. So to start off, I'd like to introduce Cy Richardson. He is a Senior Vice President at the National Urban League and a member of the League's executive leadership team. He co-leads the programs department and supports national efforts to create and measure economic and social opportunities for communities of color, ensuring that prosperity is widely shared regardless of race, gender, ethnicity, or geography. Cy's scholarly interests include economic inequality and intergenerational economic mobility. His commentary has been featured in the nation's top publications, including the New York Times, the Wall Street Journal, and Shelter Force magazine, among others. And he is a frequent speaker at a broad spectrum of events, and he is my boss. Welcome, Cy. Next, I'm going to introduce Dr. Erin Houston. Dr. Erin Houston is a native of Farrell, Pennsylvania. She is a member of the Cedar Avenue Church of God in Sharon, PA, and is currently serving as a trustee and also a member of the finance counting team and youth ministry. So even outside of her work duties, you know she's focused on her community. Dr. Houston received a Bachelor of Science in Management Information Systems with a minor in Business Administration from Gannon University, and she has a Master's of Science in Leadership with a concentration in Business Ethics from Duquesne University. Dr. Houston graduated from the Instructional Management and Leadership Doctoral Program at Robert Morris University. Prior to serving in her current role as the President and CEO of the Shenango Valley Urban League, Dr. Houston served for 8 years as the Education Director there, overseeing youth programming, employment, human relations, and coordinating community outreach initiatives. In 2013, she was a 40 Under 40 nominee, and she's also a member of the Alpha Kappa Alpha Sorority Incorporated. Welcome, Dr. Houston. So with our panelists ready, First, I'd like to just ask a general question. I would like to hear your unique perspectives on the information we've heard so far regarding financial literacy and its importance in creating change. And this is just a general reaction. I'd especially like to hear from Sai and Aaron, since we have not yet heard from you. So thank you.
Yeah, thank you so much, Ayana. And again, it's a pleasure to be with Paul Colbert and our colleagues at TIAA as well. You know, here's my kind of concern and worldview to the topic, which is incredibly profound topically conversation. I mean, I think it's incredibly insightful data and report, obviously. I mean, financial education creates both better decisions and opportunity for a household and individual. And it's clear, and I think Paul touched on this as Colbert did as well, that money works for us or against us. Poor financial literacy and poor financial decisions can be passed down through generations, as well as kind of locking in the cycle for decades. And so I think this kind of behavioral change is a very important vector in this conversation at individual, household, and community level. I'm particularly appreciative for Colbert's framing and introduction in an expansive way, looking at kind of the implications for health, wealth, jobs, intergenerational wealth building, etc. And I do appreciate the kind of contextual intro. I think the coronavirus has exposed some real gaps in our democracy, in our politics, and the legal system. I mean, this is demonstrated by the events in Minneapolis, Louisville, Portland, and other urban centers of all sizes. But minorities, communities of color, especially Black people, have been hit hard by the virus itself. But the economic or the financial impact is the most important issue facing African Americans. So there's a layering of challenges, both immediate and long-term. I think three main points, Ayana. The wealth gap in the United States is what's threatening the Americans' aspirations for social advancement and equal opportunity. If we're talking about kind of economic and racial and social justice, I think, you know, the kind of the financial acumen gap, the deficit in sophistication, in confidence as consumers at point of sale, and the preparation for point of sale as consumers is troubling. That gap that Paul laid out. But what can we do about that? I think, you know, African Americans, women, and other populations that demonstrate kind of deficiencies in the financial literacy rates. It's a major concern for businesses as well. That would see attracting a more diverse workforce as a business imperative. So I think we need to look at that. But it's also time to close the gap between those who know how money works and those who don't, and to break this kind of cycle of endless debt, foolish spending, and financial cluelessness. Anyone who wants to take control of their financial future has the knowledge to make it happen. I would argue, in our kind of worldview, as you know, Ayana, that financial literacy equips us with the knowledge, skills, to be able to make sound decisions that, you know, help us manage money more effectively, longitudinally, not just as a snapshot in time, but as that motion picture evolves. We'll be able to understand through this data the kind of delta between the desire of African Americans to consume in responsible and affordable ways and their capability to do so. I mean, I think there are a number of institutional structural headwinds there that inhibit our ability to do that on par. I think the rubric of risk-based pricing, for example, is a conundrum for communities of color. I think there's one data point that it always staggers me and I share with colleagues, which is over the lifetime of a consumer, 18 to 65 per se, cost of having poor credit, suboptimal credit, say sub 700 FICO score credit, the cumulative effect of that could be you might pay $200,000 more for carrying that suboptimal credit as you compete for credit cards or mortgages or student loans, etc. So understanding this notion of preparedness and readiness and the delta to the desire is quite important. And the last thing I'll say is in kind of assessing and understanding the index, in my own mind, I kind of overlapped and overlaid it with Maslow's hierarchy of needs. And looking at kind of the base pyramids do overlap with kind of basic needs that people are contending with, and versus the top of the pyramid, which is this of self-actualization. I would argue that the financial education, the financial acumen, the financial literacy component, which kind of can be the solution for this kind of delta narrowing between desire and capability, I think that is a real kind of vector in the conversation on Black people as relates to financial management and financial acumen in terms of baseline kind of needs and desires, everyday, immediate, short term, again, because of the economic precariousness of our communities living on the margins, versus the longer, the longitudinal, the tomorrow thinking of the self-actualization of communities. And I think if we build self-esteem individually, household level and community-wise, I think the financial education component must come behind, because that, as Dr. Yakubowski said, could become the great equalizer. And that's something I'd like to talk a bit more later. Thank you.
Thank you. Erin, did you have something to add?
Sure, absolutely. And the data was quite interesting to see as well. And just to start off by saying that financial literacy is definitely something important that the African American community should take a harder look at. I mean, I know a lot of times we talk about the power of the Black dollar, and it's a lot of time running parallel to conversations about spending, but really even changing the narrative and saying, you know, the power of the Black investment, and really looking at how that conversation can spread throughout the Black community and changing that narrative. One of the main things that we do want to work on getting in and achieving is that generational wealth, and figuring out how we can have homeowners in the Black community, more homeowners in the Black community. I know a lot of times we have a lot of maybe debts that keep us from becoming homeowners, or even just prolonging that endeavor. So figuring out ways that, you know, we can talk about the power of our investments and the long-term effects it can have for our families. I mean, I know we kind of got a slow start centuries ago, or, you know, with even going as far back as slavery, and then now, you know, Jim Crow laws, and being kept from being able to live in certain neighborhoods. So now that I think there's some like kind of an awakening around financial literacy and the importance of it, I think we have an opportunity to really make a change and a long-lasting impact in the Black community around our finances.
Thank you. Colbert, Paul, I don't know if you had any reactions to that, to what was said, or if I should go into the next question.
Sure. You know, there's so much to say. There's so much to say. You know, I kind of focus in on statistics a lot, because they tell the story. I think the issue is financial literacy is a great foundation, but you actually need the financial wherewithal to take advantage of whatever financial literacy you have. And in an environment where over the last, you know, 25 years, just the cost of living has gone up so exponentially and wages have stagnated, doesn't create the opportunity for that excess income, if you will, to be redirected towards savings or investing. I think there's a huge correlation, I'm not a statistician, between, you know, stable income, education, and having the ability to organize your financial future. Just some research I had done, when you think about who is able to own stock ownership, aside from participating in the stock market, which over the last 60 years has contributed about a 6 to 8% return, you know, over that period of time on average. Obviously, there have been some years where it's been exponentially higher, and obviously some down years. That and home ownership, to Dr. Houston's comment, is what really creates wealth, and also creates the opportunity for intergenerational wealth transfer. When you think about who owns stock ownership, and by the way, it's not individual stocks. The stock markets, the markets in general, were democratized with the creation of mutual funds and ETFs. So more people have access to these financial instruments than ever before, through IRAs, through their 401k accounts, et cetera, through a lot of these discount brokers. So there's more access than ever, but it's still a concentrated number of folks who are using that. So in terms of when I think about financial literacy, I always say, what are you doing along that saving, appropriate debt management, which Sai alluded to, investing and protecting, ensuring what you have, right? You've accumulated and aggregated all these assets. 65% of whites own stock versus 42% of blacks. 80% of college educated people own stocks, 33% non-college. Those earning more than 100,000, over 85% own stock. Those earning less than 40,000, 22%. So a lot of the elements of creating financial literacy and taking advantage of understanding how to organize yourself around preparing for retirement and other things, it's really connected to having a stable job, access to home ownership if possible, and really participating in all those different phases of your life. So I think that's crucial. So if you're earning a decent wage, you're more likely to utilize financial literacy tools, engage in them to kind of craft a better future for yourself and your heirs.
Ayana, I just got to say, if I can comment on that, because I think, I mean, Colbert's laid it out, I mean, in stark reality. I'm interested in, to this point about the data, you know, the kind of forward-thinking dimensions where we're deficient, ensuring, comprehending risk, and investing. Those are like the kind of tomorrow features of the wealth building equation. And the kind of layering of deficits in those very areas, it is and should be deeply concerning, not just to Black America, but for all America. Because looking at, you know, opportunity, you know, kind of removed because of that forward thinking, that tomorrow kind of conversation. I'm kind of deeply concerned that institutionally, TIAA's industry, the field that they're playing, the financial services field, what can we be doing more to bring products, services, information to communities in those very areas with urgency? That's kind of, I think, the kind of solution-oriented conversation I think Paul's data is begging to have.
Oh, I didn't know if one of you wanted to respond to that.
Just, I mean, that's just.
No, I think it's an important question.
Shocking to me.
Look, if I'm in the financial service industry, I want more customers.
Yeah.
And the way to have more customers is to have people who can participate and utilize some of the products that we manufacture that we think are appropriate for them. And so if you have a segment of the population that can't really fully participate, you're narrowing who you can serve. And I think if you want to try and have the financial services companies try and be the mechanisms by which you create more economic fairness, then we need to have more people participate in the process. I think that's important. And quite frankly, to me, financial literacy is a life skill. It should be mandatory in every school system that you understand all the different elements, because some decisions you make at 18 or 19, what's the first thing when you go to college? They overwhelm you with all these offers to open up a credit card, right? So you feel like an adult. You're not really an adult, but you feel like one because you've got your own credit card, and you make a missed payment. It stays on your record for 7 years, right? That's an impact. When it goes to starting to underwrite a potential mortgage, people look at every aspect of your financial life to see if you are worth a risk over a 30-year period. And so all the decisions you're making when you're 18 or 19 could impact you to the time when you're 25. And if you're 25, you make bad decisions, it impacts you till you're 32. If you're 32 and you make bad decisions, it impacts you till you're 40. And if you think about it, sometimes you have a good credit rating and you don't know it, but you're using products that are not appropriate for you. If you look at the subprime mortgage situation, there were a number of people who actually had subprime mortgages who would have qualified for prime mortgages.
But that's Colbert, I think that's a fascinating point, because, you know, a credit score is not a static thing. Financial literacy suggests that can be improved through behavioral modification and change. We need to also make sure the other side of the equation that service providers, product providers don't keep offering the same products to folks in a static way, but those products change and are dynamic as people's needs, desires, and capabilities change. And we see it, to your point, people who could have qualified for prime are still being offered subprime. That's a structural headwind, I think definitely is here, isn't it?
Yeah, and
Yes.
also if I can add too in that, I think a lot of times, I think it would be important to have maybe some education around that for the Black community, a little more outreach perhaps. I think the education piece might be missing, from those lenders, for the Black community. I think that might be a piece that can be incorporated.
Yeah.
Yeah, and I think to add on to Colbert's comment about people who qualified for better products and were still offered only these subprime products, I mean, that's just predatory, right? But at least, if we're educating people more, then they can at least know the indicators or have an idea of what they qualify for prior to submitting their applications.
Right.
But yeah, it was a very disappointing element of what happened and contributed to the foreclosure crisis. That we saw people who should have been offered better products, and instead, were offered these subprime products that hurt them even further financially. Paul, did you have something?
Yeah, I was going to say, related to that is the use of, I think it's termed alternative financial services. I think payday loans, title loans, rent-to-own pawn shops, and it's very highly correlated along multiple dimensions, income being one, but financial literacy and understanding what a bad deal that is, and the ability to go look elsewhere and not get trapped. Financial literacy and start spinning a wheel and digging a hole. So yeah, it just connects along all these dimensions that are being raised.
Yeah. Okay, thank you for that. So speaking of, since we launched into the conversation on investing, I'll just touch upon this, and if there's anything more to add, please do. But to reinforce Paul's data, investing is the third lowest knowledge area for both African Americans and the general public, and it's usually seen as only belonging to the wealthy. So are there any recommendations for either educating or getting lower income clients started in this area? Colbert, you mentioned ETFs. Would you like to just briefly mention what that is for people who don't know?
ETFs are it's a security, it's an exchange traded fund is what the acronym stands for. And it's really a conglomeration of other underlying securities that you can trade on. So you can have a ETF that's focused on the energy market, which comprise of a number of stocks within that ETF. You can have one that's focused on financial services, one that reflects the S&P 500. So you can sort of engineer a lot of these different things that are a proxy for a particular market or sector. So that's what's democratized, if you will, access, because now the amount of money you need to open up some of these accounts are much lower than they've ever been, sometimes as low as $500. So that's, financial services companies, like, how do we, they don't want to just cater to a very small percentage of the market. They want to cater to as many people as possible. And by democratizing the minimum amounts needed to open, by creating securities that make these markets accessible to more, that just increases their ability to serve more and to provide financial advice to more individuals. So there's a profit motive embedded within that. And then as your needs become more complex, you'll have different types of products that you need, including life insurance and other things of that nature to, if you will, protect what you've invested and the asset that you have, also your home, all these other sorts of things. So I think it's very important to continue to do that. And there's going to be a certain level of anxiety. I work at TIAA, where we cater primarily to academic institutions. So you can very often have someone who is a professor of engineering at MIT or Carnegie Mellon, who is very anxious about trying to think about the stock market because that's not their area of expertise. So there's a level of anxiety across all different types of folks around investing, because it just seems like it's such a rabbit hole. And then you read some of these documents and you're further intimidated by how difficult it is to ascertain what it is you're investing in, and also being able to manage the risk. And not everyone has access to a financial advisor. And so then you're asking people to do this on their own. And that's a very difficult task if you're not really knowledgeable about this area. So what often happens is there's an aversion. I'll do something that I understand, even though it's against your financial well-being. So when my mother retired, she asked me to take a look at her financial things, and she had been investing in money markets for years. And I didn't have the heart to tell her the opportunity cost of her investing in very, very conservative fixed income securities, as opposed to having some portion of her wealth in equities. But it was significant over the course of 30 years, as you could imagine, that differential being compounded. So I think
is that the comprehending risk? Is that an illustration of comprehending risk there, that vignette, Colbert, or is that a different dynamic, would you say?
It's about risk, because, hey, I know if I buy a bond, I know I'm going to get 2%. Right. If I go into equities, I could get 25. And they, a lot of her and her friends would equate it to gambling. Yeah. Like, I don't know what I'm going to get. I like certainty of outcome. Right. Certainty of outcome, if you kind of chart it, hey, the stock market typically returns 8% a year, on average. And so she would have been much better off, and her friends would have been much better off. But they were so concerned about, I need to have a retirement nest egg, and I'm not willing to gamble with it, and led them to do things that were much more conservative, not during the years of between 25 and 30 of I'm going to retire in 5 years, but even when they first started saving. So those are kind of things that I think if people were more informed about, they would have the appropriate level of risk through how they allocate their assets, and they would benefit and have a much more secure retirement as a result of making those decisions at a much earlier stage in their lives.
Yeah, and I think that, along the lines of investing, I think there's a great opportunity for school districts to really be able to to educate students as young as they want to be, but at least at the 16-year-old age group, because that's where they can start working and start investing early. A lot of us, like for instance, myself, I didn't really do anything that had to do with investing. I had to do the stock market game as a freshman in college and had no idea about it. And, I had to take a class, and we were in the stock market game, and, I had no idea. And I wish I would have, because there were students in my class who did. And I felt, 5 steps behind. But I think instead of waiting until adulthood to really start talking about investing, as a financial planner is important, but I think the school district should really take charge in the high schools, at least expose students to the opportunities around investing, because I know they understand about spending the money they earn from working, but they're not really taught or talked to about a lot about investing the money they're earning.
Right. If I can just piggyback, I think kind of coming out of Dr. Jakubowski's data, clearly there are, in reality, different kinds of conversations happening in a lot of, African-American households around money, saving, investing, and the financial trajectory for tomorrow. One initiative that the Urban League is participating in, and TIAA as well, is working with the Center for Financial Planning, the association which grants the CFP designation for financial planners. It is, to Colbert's point, to democratize, diversify that profession, which finds itself at an existential crossroads of being, for lack of a better term, pale, male, and stale, right? To reflect civil society, where America is going, and can that bring, Colbert's point, drive more people of color, heightening their awareness, their interest in participating, finding identity in the market. And to the degree that can be culturally attuned and culturally appropriate, culturally sensitive, the degree to which people of color feel more open, honest, and readily available to share, being vulnerable to people who look and have the same experiences as them. That kind of shared experience could be a game changer as we try to bring more people into the investing, insuring, and comprehending risk, and also the sources they go for that information. Are they credible? Are they culturally germane? So, I mean, I think this is both a workforce development issue and a larger wealth building challenge as well. But I do see the challenge that we don't have a lot of people that look like me in these conversations with Colbert talking about what he's talking about. I think that's the next frontier for Black America, is to really have a moonshot of an initiative to bring more people of color into these professions, and then go allowing them to tap in their social capital in communities to bring the community in this emerging, ensuring risk comprehension and investing conversation. Otherwise, we'll be semi-permanently on the outside of it looking in.
And if I can add to that too, Sai, because I have a friend who is a African-American financial planner, and, you know, and with talking with her, she, you know, has been a financial planner for the past 10 years and has done outreach, you know, around in the local community and in the Black churches. And, you know, and within that time frame, she's really only gotten maybe 1 or 2 or 3 people wanting to come to her to talk about their finances and to talk about and the opportunities to invest. So, you know, so it may be something around, you know, feeling like you don't want to, like you're losing something there, or you don't have enough money to invest. And I think there's, you know, some conversations that can be had about what will it take to invest? Because I think, you know, for the purview of the wealthy to be the only ones who can invest, because it seems to be you need thousands to be able to invest at minimum, but that's not necessarily the case. But I think there's a misconception there about that.
Right. I'm going to move forward with the Q&A section, because we did touch upon the questions that I had already prepared, and we are running a bit low on time. I just want to indicate now that I'm aware that we said we would end at 5, but we will continue the conversation. So if you're able to join us past 5, then we welcome, you know, your staying. So a question that we received from Nina Harris is, do metrics indicate that the household income threshold determines financial stability, such as life insurance, preparation, etc.? Or is success in African-American households in such areas guided by financial literacy acumen? In other words, does data reflect that financial literacy in African-American households truly makes the difference, including those that are low income? We provide direct services in the area of financial literacy and are often asked about the success rates in low-income households. So I think, Paul, that might be a question for you, but it's basically, does financial literacy in African-American households make the difference, even for those that are low income?
Well, as I said to begin with, both matter, resources and financial literacy. I haven't seen good data that interacts them. Anecdotally, we all know of instances people seemingly should have enough money, find themselves in financial trouble. Vice versa, individuals with really modest means have a smooth financial ship. So it is the interaction of the two. And again, it's not that financial literacy is a magic bullet. But at the same time, it does make a difference. Again, you look at those data points I showed between financial wellness and financial literacy, and the positive relationship and the closing of the race gap along those dimensions. And boils down to, especially when you're interacting with household income, and think about household incomes that are lower and lower, then very quickly you argue that, well, it's even more important to have the financial literacy to make wise decisions when I have less to work with.
Right.
That I maximize it. And this can manifest itself on even the seemingly most trivial things that free up dollars and that add up. My favorite example, and I had this conversation with my son, is everybody has a cell phone. And as soon as you're just about to walk out the store. They said, "You want to insure that?"
Mhm.
And I don't know what it was, $10 a month or whatever. And no matter what happens, you'll have a new one. And I told myself, $10 a month, okay, $120 a year. You can't buy a good case, or you can't save that $10 a month every month and have it just in case. And I did that on my cell phone, and I did that on my flat screen, and I did that extended warranty on. And all of a sudden, I'm buying insurance on top of insurance and not really viewing it as insurance. And those are real dollars
But
that I could be saving.
a real, yeah. But I want to say,
Self-insured.
but imagine if you had a
difference.
if you had a 610 credit score, you'd probably be paying 3 times to insure all those things. That debt trap, you could be caught in.
Right. And so again, insurance, just one example here. It's understanding what to insure and what not to insure that we often don't think about, and freeing up dollars that way, and making my deductible as high as I can, and just driving carefully, and freeing up more dollars. And all of a sudden you're talking some real dollars that you can save and invest. And that kind of savvy, when I have less to work with, matters even more.
Yes, thank you for that.
Absolutely.
We have another question from Anissa Franklin. She asks, often low-income families are intimidated by finances and are coming from a cycle of poverty. How do we engage those who are so financially depressed to engage and learn? So how should we interact or approach those who are financially depressed?
Well, as you know, Ayana, maybe you can speak to this. We're launching a financial therapy pilot program, which looks at the psychological burden, the psychological pain to being in this kind of financially deficit position with decision making, but also the resources available to you. And so, I think that's an emerging area. We'll have a wealth of qualitative and quantitative data on attitudes and behaviors, and how to kind of counteract that, what kind of dosage people need to get back on fair terms. But I do think this is an emerging field, along with financial coaching, as you know, which can be beneficial for the nonprofit community. And it's a legitimate area, an academic credentialing area that is emerging for us.
Yeah, I think you make a good point. We are launching a financial counseling initiative that is really focusing or recognizing that people are more than just balance sheets. They're more than just their bank accounts. And the decisions that they make are driven by things that are much deeper, such as emotions, such as past learned behaviors, and just attitudes towards money. So it's not just the money. It's also all of these other factors that come into play. And so we are creating that initiative in order to address that.
And if I can add, I think that that's actually very excellent to do that, because in one of our programs, we offer financial literacy workshops, and in that program, there's a challenge that the coordinator does with the participants who are in that workshop. And over time, they can either save a certain amount each week and come to a goal that they want to raise in a month, and it'll be doubled. But they opted to just go with another incentive that was to pay off a bill. So they'd rather pay off something, a debt, versus save and double what you save. And, so yeah, so I think, whatever the behaviors or the thought processes behind that, may come with that. So this initiative would be perfect for something like that.
Yeah. If there's nothing else to add to that, we have another question by Jonette Brown. She said, we understand the importance of changing cognitive behavior relating to financial education in certain communities. What are your thoughts around synergy between organizations and underserved communities in terms of investing, general retail banking, and other financial products? So I think they're asking about what's the synergy between organizations such as ours that are working in the community, in underserved communities, as far as sharing with them financial products.
Look, I think this issue, there should be a collaboration. I think if you've noticed, there are a lot more banking opportunities and infrastructure more than ever across a number of cities than ever before. Quite frankly, banks derive a lot of their profits from, if you will, retail banking. And I think more and more folks are starting to understand that going to a check cashing facility to buy money orders and cash their check is not a viable long-term solution. I think what banks have done is manufacture a number of products that are much more suited for folks who want to have a basic checking account and have very basic services that are much easier to access and much less expensive than some of the other alternatives that they historically have had. So I think you've seen a change in that process over time. Once again, we want more clients, we want to serve more, and there's been a proliferation of banks and branches, and I think that's helpful. Now, the second phase of that is, are you recycling those deposits and that activity into access to capital to build small businesses, to originate mortgages, to foster more home ownership? So that is the phase that needs to be focused on. It's just not taking in, but what are you recycling in the community that builds better communities, higher home ownership rates, which leads to more stable communities, which leads to increase in economic self-sufficiency, reinvesting in your home to build its value. So that's the next phase. It's not just having the ability to allow folks to facilitate certain transactions. It's also, are you allowing that capital to be reinvested in those communities to build long-term stable communities?
Can I just follow up on that, Colbert, to you? Because I think that's spot on. My question back to the data is, if we were to narrow, bring that 17% down between the 55 of the whites and 38 for black, what would that look like materially? Would that be discernible? And is that an important precondition to making those products and services more optimally efficient and effective for the communities they're designed to serve?
Yeah, there's a lot of operating leverage, because once you have a branch system, but then the majority of folks are doing things online. So these products don't have, there is no, if you will, there's no finite amount of checking accounts that you can have. You can have as many checking accounts as you want because the infrastructure can handle so much. So if you have your cost is X, and your cost actually goes down the more people you serve. So the more people you add, the more economically advantageous it is to you because your fixed costs are Y. And so I think they're looking at that math and deciding that if we have more people as part of our platform, it makes our business a lot more, if you will, economically profitable and creates even more operating leverage for them. So,
and the payday lending and check cashing people are doing the same, right? So it's a battle for the.
Yeah, they're doing the same, but the banks have responded by giving you and some other payment process by giving you earlier access to your paycheck and things of that nature. Payday lending, if you look at the math, I mean those rates are somewhat usurious, right? Yeah. That's those are not products that you should be utilizing, and so regardless of your economic sort of situation, to a certain extent, that's why budgeting makes sense, because I think what's happened over time is as folks have been trying to manage their cash flow, they've introduced using high interest credit cards or payday lending to service that gap. And by having more effective debt management, you're less likely to use those type of instruments. You're less likely to overdraw your checking account because those fees are tremendous as well. So there are just a lot of different factors that, once again, we talked about this, making a bad decision at a certain time could lead to a domino effect that really impacts your financial well-being.
Such an interesting discussion, and with so many more interesting questions. I do want to also be aware, Colbert, if you have to drop off shortly.
Yes.
Then
unfortunately, I could do this all day.
I know.
So I appreciate the opportunity, yes.
Well, I'm going to ask the last question, after which you may just choose to say goodbye. But the next question is, Thomas Boston, who wrote Race, Class, and Conservatism, argues that a new class is often invoked, but variously defined. Roughly speaking, it comprises the educated white-collar workers who do not or have not won the physical means of production, but who nevertheless act as political and economic forces through intellectual activities. So he's saying behavior is part of it, but systems through policy is a huge factor. Education is great, but pooling resources also has to be enforced. What's your view on this? And this is asking about policy and pooling resources. And Colbert, if you have to, if you would like to just say goodbye or say a couple words before you say goodbye.
That's a question that's I'm not sure I'm qualified to answer. But I will say this: there are no short-term solutions to this. I think you need changes in law. You need changes in behavior. You need community organizations that serve as effective advocates for change. And then you need the politicians to look beyond the 2 and 4 year and 6 year election cycles to do things that they may, when they're out of office, they may not get credit for. So I think it's a combination of all those things that's going to result in some everlasting change. Wealth inequality didn't happen overnight. If you look at the statistics, this happened over the course of the last 30 years, been masked somewhat by easy access to credit and people kind of living a middle-class lifestyle by using credit. So we have to go back to the basics and say credit is something that you use not to support a lifestyle, but to use appropriately for things like paying for an education or buying a home or starting a business. So we have to reorient it from debt is for consumption to debt is for building wealth. And I think if we can do that with the right amount of financial literacy programs, people will start to make better decisions. And what you'll see is over the course of a generation, you'll see a much different landscape for those who are participating in our economy.
Thank you so much. And thank you for joining us today. We will continue without you, but we wish you could stay.
All right. Thank you so much. Thank you all.
Okay. Does anyone else have an answer to this question? Really about policy and also pooling resources.
Well, I'd like to pick off Colbert's closing comments around debt for a moment, and good debt versus bad debt and impact that debt has on the choices that we make. And I showed data about being debt constrained, and a fascinating finding out of our research, and we've seen it in other research we've done and other research that others have done, is this paradox that student loan debt has a disproportionate effect on current financial well-being, disproportionately negative effect. And you sit back and go, well, why does it matter that it's a check that's going to service my student loan debt versus servicing a new car? If I owe the money, why does it matter where it's going? And as we look into it, it's a bit of understanding what I was borrowing when I was borrowing. And what I mean by that is, if I go in today to buy a new car, I'm going to know with great certainty when I walk out how much I owe every month and for how many months I owe it. Because I'm going to initial my document 5 times beside those figures. When I borrow student loans, am I really paying attention to, well, okay, I borrowed 10 grand. What's 10 grand translate into 6 months once I leave college? And then when I add another 10 grand on my second year, okay, add these together. What's that mean my payment's gonna be?
Mhm.
Nowadays, yeah, when you're doing your FAFSA stuff, they run you through an exercise and you get that information. But, you know, when you're 18 and 19, you're just flying through that and clicking the boxes. Do I really get it? And then all of a sudden, when those student loan payments show up, once I'm out, I'm surprised. Well, I knew they were coming, but I didn't know how much they were going to be. And it's not even in general that student debt is large. The average student debt is roughly equivalent to go out and buying a modest new car. So it, in that sense, shouldn't be problematic, but we're not allowing for it. We're not planning for it when we begin. And put aside, you know, to somebody, you know, who runs up a couple $100,000. You know, we see those stories, but those are far from the norm. It's more allowing for that and planning for it. And also, again, this would be part of, you know, in my view, part of financial literacy that gets discussed in particular in high school. The people that are really challenged by their student loan debt didn't graduate.
Yeah.
So
Well,
didn't
yeah.
get the payoff of that money that they borrowed, which was the degree, which then translated into the income. If I borrow money and then don't complete, I've really put myself behind the eight
I
ball.
think that's deep. Yeah.
And having people understand that in school, you know, their senior year of high school or their freshman year of college, and then working with them so they can stay and don't let little financial obstacles get in the way of, you know, yeah, okay, I have 5 parking tickets on campus and I can't re-enroll till I pay them, but I don't have the money.
Yeah.
Is that really a reason that we want to lose somebody out of college? No,
Yeah.
Absolutely not. Some colleges can help in that way, and students can understand of, yeah, I want to be out of here because of 5 parking tickets.
Yeah.
I'm not going to get the parking tickets.
Yeah. I think it's even more perverse than that. I mean, I hear you're saying we need more the appropriate speed bumps and guardrails during the FAFSA prep process, definitely, and that should be evenly distributed, that opportunity. But I think we've also seen it in I say in a more perverse way. In many cases, to your point, Paul, folks are taking these student loans, taking these degrees, and being forced to pursue professions that they believe will remunerate them significantly to be able to pay back student loans, but they're unhappy in those professions. We're creating a lot of unhappy lawyers, unhappy doctors who don't want to be into community service, who are not interested in the kind of giving back dimension to that work to communities of color, driven by the student loans that are sagging them down and the weight of that, and then causing other poor decisions moving forward. It is a cascading set of factors, like you say.
Yeah, and even with looking at the student loan aspect of it and taking out loans, I mean, I know a lot of parents who have taken out Parent Plus loans and all kind of loans for their children to go, or their young adult to go to school. And I think they're looking at that as, you know, an investment into their child. You know, it may not be an investment into the stock market, but the investment into their child to maybe, you know, have a better life maybe than they had, or a better opportunity with education than they had. And I think even in one of the statistics or in the data that was shown earlier was that college degreed individuals have, you know, maybe higher financial literacy and with an opportunity for their child to go to college, finish, graduate, then there's maybe better opportunities for them. So I think they'll take on those loans, not really looking at the risk, for the sake of having their child have opportunities greater than they had.
Yeah.
And part of that risk is, does the student stick? And does the student complete?
Yeah. The persistence. Yeah.
No great insight to say, Lord, that matters a whole lot to the outcomes for the student and the parent ultimately.
Yeah, as a person with student loans, this part of the conversation definitely resonates. Just to answer some questions, we will be sharing these outcomes with you all post this call. So thank you. Okay, here's another question, and we're almost done. So thank you all for those of you who have been able to stay with us. Carmela Walker says, IDA programs are essentials too, especially for the underemployed and those who want to build savings. And it was dismantled in 2016 via the federal government. Is there a way to bring these back without having it tied to education and or home ownership?
Ayanna, do you want to just speak about the Isusu work that we're doing?
Yes, so we have an exciting initiative with Isusu. They have digitized lending circles. So it's a traditional practice that's been used for many, many years, mainly in communities outside of the United States or those who have brought them with them here. And basically, people are able to engage and save money as a group in a way that forms community and also helps improve savings and their credit scores. So with this, we have a program, we have an initiative right now that focuses on not only bringing those elements and subsidizing the fees associated with using Isusu to build their credit and savings, but we also have a matched saving initiative. So if you're in certain cities where we are supporting this work, then you are able to get some amount of money matched to your savings, which we consider a huge incentive. And that actually has been interesting because for some clients, those incentives are not quite enough because they feel like their resources are stretched so thin. So we are trying to impress upon people, especially, Paul, like you said, those who are at the margins and don't have much, especially need to be thoughtful about their finances. And so, we have launched this and we are excited about it. And that's, something similar as far as having match funds available that we were able to bring into our work.
We have to comprehend the reality that the match means an instantaneous 100% return.
Yeah.
You will never get that anywhere else with money.
Which getting back to our financial therapy work. Go ahead, I'm sorry.
Yep, go right ahead.
You've just said the point. I mean, that is self-reinforcing, self-actualizing, that kind of return, how that makes you feel to modify behavior to want to do that again with others. That is exactly right. We're trying to kind of build on that ethos.
Okay. I think actually, I think we might have gotten through all the questions. Silky, please let me know if I have.
There is one more question in the Q&A box.
Okay, about debt prevention. I just saw it.
Yes.
Okay, thank you, Silky. In terms of debt prevention, especially for young people, are there state or federal policies that prevent predatory practices on those who may not be financially savvy or responsible? So are there any policies, especially for young people, that can prevent predatory practices in terms of debt accumulation, or prevent just predatory debt practices?
I'm not aware of age-specific initiatives, but obviously we are universally interested in the payday lending and check cashing industry and usurious tactics at the state and federal level. We've been an active commentator and participant in what are, there are small dollar loan needs every day. To Paul's point in the data around people who have economic crises in the short term. They are a captured constituency for these industries if the mainstream financial services institutions don't similarly develop products to serve them. I am deeply concerned that absent those alternatives, as we mentioned earlier by Colbert and Paul, early on, this demographic profile, under 21, under 25, that is their experience and comfortability working through these institutions that are ubiquitous in communities of color. I think that is something institutionally, not just front foot with responsible colleagues and thought leaders like TIAA, we also have to engage these other more unscrupulous, predatory, subterranean actors, because they have the trust built up, they have the social capital, they have the proximity, they have the racial connectedness, and they have a perfected argument and messaging as well, built around urgency, convenience, and proximity. We have to think about that as well.
Okay. And someone in the comments mentioned that perhaps the fact that you have to be a certain age to sign certain contracts, that could be helpful in the safety of our youth. But yeah, to the earlier point about, you know, students being introduced to credit cards, I remember my first credit card was, I got a t-shirt. I wanted a t-shirt for the job.
Yeah. That's how I ended up getting my first credit card. I wanted the t-shirt that said college. So I got the t-shirt and the credit card. So yeah, I think there's something to be said for early exposure and education of debts, debt management, consequences, comprehending risks. I think there's something to be said there, and opportunities that, I think I said earlier, that school districts should really take a hard look at, so that when students get into higher education, they're not only in debt because of their loans, but also in debt with credit cards, you know, so soon anyway.
Yeah.
You may need one down the road, but so soon, and not understand the risks.
Sounds like y'all got that same Discover card with a 26% APR like I did.
It was, yeah.
You know, the flip here, in all seriousness too, is not to scare the young people away from credit cards.
Yeah.
And think about, well, I'm
As a credit builder, yeah.
Senior year. There's a lot to be said for getting that credit card and treating it like a debit card.
Yeah.
I mean, yeah, I'm going to use it to buy things, but only up to the amount that I have in my account right now, so I know that I can pay it off every month. To begin to establish that credit. Because all of a sudden when I'm out, that matters. And to be out there, you know, it's creating the savvy to understand the trade-off. To have absolutely no experience with credit and paying it off successfully, even on a small scale, that doesn't do me a favor in terms of getting loans. I mean,
Yeah.
a credit card and abusing it is going to be a big negative.
Yeah, exactly.
But having no credit card that I've never worked with, well, that's still going to be a negative. It's going to be a smaller one. But having that credit card, yeah, I've used it to buy a t-shirt that I then paid off that otherwise would have, you know, whipped out my debit card for. That's great. And that's a little small thing.
Right.
But they have to understand, you know, don't use it like a credit card. Treat it like a debit card. And if it's not there, don't buy it, but begin to establish credit.
I totally agree, Paul, but the irony of it is, the paradox is, in many cases, the debit card was created to look like a credit card, right? I mean, it's just the traffic of keeping up with the Joneses and layering all of this with that, the perception of being, you know, something that we may not necessarily be. So that's right.
Yes. Thank you. Okay, this is the final question for real. So please hold on, those of you who have stayed with us. One last question. So Carmela asks, when folks are behind the starting line by 15 to 30 years, now it's a behavioral issue? What modalities can be used beyond education? Small business? We can't keep demanding access when we continue to be marginalized. Pooling money seems to be the answer, or investing in commercial properties to build in that manner. What is your position on this? Yeah, that's a huge question. Sai, you look like you have an answer. You're on mute. Oh, you're good.
I have a long answer, but I think the short one is, I think Carmela's right on. That kind of modern the civil rights movement in a modern sense is looking at kind of community control, community empowerment, for us, by us kinds of economic platforms that make us self-sufficient, resilient, and on par to demand suitable and affordable products and services from our mainline financial services firms who exist within civil society to serve and benefit all of us. So I think that's right. I think that doesn't have to be a radicalized message. I think it's a legitimate message. We have to refine it, own it, perfect it. That is the modern civil rights movement right there, to me, Carmela.
Okay, thank you. Are there any closing thoughts as we wrap this up by any of the panelists?
I'll just say in closing, kind of where I started in the beginning of this conversation is changing that narrative. You know, the Black dollar, the power of the Black dollar is oftentimes, you know, in regard to how much we're spending, but to change the narrative to the power of the Black dollar and how much we're investing. So to build generational wealth, you know, let that be, you know, a guide or an end goal, generational wealth for our families.
Right on with Dr. Houston there. I would say, again, I'm extremely intrigued by the data set, the research project, working with TIAA as thought leaders. I'm particularly interested in the dimension of the go-to for informational trusted sources. I think that is an area, I mentioned to Paul previously, an area for future research, looking at how can we harness social capital and trusted voices of the Black community to bring the community into the mainstream, and then also bring the services, products, and actors that can reinforce that. I think that is an area we'd like to continue working on.
Yeah, I think that's a great point. So I mean, people have to realize you don't have to know everything. You don't have to be an expert on everything. And you don't have to be Warren Buffett or whatever. But a basic working knowledge so that you're comfortable walking into a bank as opposed to walking into the payday shop.
Yeah.
You're comfortable asking questions and you know, knowing what to ask, and then doing the follow-up. Nobody knows everything. I mean, you're continually learning. I bought a car in January and I'm 60 years old. I don't know how many cars I bought. I think I finally got it right, because every time you learn something, that's the way it is. So it's getting that base of knowledge and then just learning how to learn as you need it along different dimensions.
Thank you for that. I just want to add one last point. Jean Vernon added to the point about pooling money in a safe way. We can do that also with the products and tools like eSusu. So with that, I'll actually share a financial health toolkit that we created that includes a number of our fintech partners that can be helpful in providing resources to help address some of the financial health gaps that currently exist, and it's in a way that you can operationalize it immediately. So we'll also share that with the materials post this call. Thank you so much, everyone, for joining us. This has been a very hearty and interesting conversation that has been very relevant and informative for me. I hope it has been as informative for you. Please keep an eye out as we will share this recording and information very shortly so that you can also share it within your network. Thank you so much and have a great day.
Thank you.
Thank
Thank you.
you.
Thank you.